go. Well, welcome to another webinar for the middle of November. Geez, we are almost at Christmas time, and the end of our awesome year 2022. Today's webinar, we've got hosts Riz and Ben from Inspire, and we're here to talk about solving company loans, or some of you might know the accounting lingo, which is Division 7A problems. So these can be pretty prevalent, especially in the mid to long-term growth of a business, where we sort of see these things popping up in the accounting space. And we're here to sort of deep dive into a few different topics around Div 7A. If this is one of your first webinars with us, I just want to welcome you to our team, our lovely, beautiful team on the screen there now. This is Inspire on our rooftop, but in terms of it as a team, we're pretty well known for saving our clients a heap of tax. And as at June, or the end of June 2022, that number was at $22 million, funnily enough, in 2022 in tax and counting. So yeah, that's kind of what we start the conversation with. And it's cool to see that actually quite a few of the people on the call today, we've been able to help through this process of saving a heap of tax. If you're not working with us at all, one of the ways you can sort of suss out whether we might be a good fit is to book in a strategy call with one of our accountants. Our team member, Ronaldin, has just posted in the chat box. If you do want to go and book one of those in throughout the webinar, feel free to do that. And we actually, just in terms of if you're a current client and you want to have a conversation with your accountant around this Division 7A stuff, then please book a Zoom in with your Inspire accountant. So this is a separate process to the strategy call or the initial chat with an accountant if you're not a client. But if you are a client, then you can book in a chat. There's no cost to have a chat about that Division 7A stuff if you do need a quick check or a refresher. Awesome. Hey, a couple of months ago now, it's actually 2 months, I launched a book called Wealth for Life. And actually there was a couple of people on the webinar today at the launch, which is pretty cool to see. But if you do want a copy of that, you can access that at the links in the chat box or on the screen. But what I sort of wrote in the book is the 9 steps business owners should follow to create wealth for their family and their life. And so we talk about things like, making sure you've got a vision, through to understanding what financial freedom is, how much you might need to retire, all through the more finicky things like estate planning, insurances, SMSFs, including like property and debt as well, and maximizing that. So there's quite a few topics in that. If you do want a copy, then please grab one and we'll mail that out to you in the next couple of days by using the link in the chat box. And just before we get stuck into our current webinar, the next webinar we're hosting is only in a few weeks, which is all about getting a business ready for sale. So what we've noticed in our client base is we've had more and more clients ask us about, what does it take to get ready for a sale? How do I sort of approach how much money I should ask for in terms of valuation? How do I sort of prove this to the buyer? And what are some other things to keep in mind, like, let's say tax involved on the sale of a business. So again, Riz and I will be presenting a webinar in a few weeks on the topics around this. So yeah, from the valuation methods and how that's done, through to the tax impacts, through to just like general due diligence process and what that might mean, including who you might need on your team throughout the process of a sale to another party. So
it's an interesting one, that one, Ben.
It is. It is. We've done topics on a similar sort of stuff, but nothing sort of just squared straight at actually selling a business. So yes, that'll be a good one. And then who are your presenters today? Well,
yeah, let me take the opportunity to introduce the guy who's been speaking this whole time, Mr. Ben Walker. And for those of you joining us for the first time, Ben's the founder of Inspire, and he started Inspire when he was a wee lad at 23 years old. And he's an award-winning chartered accountant, and yeah, he's got a heap of experience. And I have the pleasure of calling him a friend and also a mentor as well. It's he's he's written a a few books as well, Wealth for Life being one of the most recent one. And I think you have a few up your sleeve as well, Benny. That might be a bit of a secret, but I think we've got a few coming out as well. So really excited to see more coming from you. What he doesn't tell you as well on this slide is he's a big fan of smoking meats and spending time with his beautiful family there, as you can see. So cute. Your family's growing every year now, Ben. Every time we do this webinar, there's an extra photo we have to add. Very cute. Did you want to take some time to introduce your family there?
Yes. So this is a photo of me at our baby shower for our third baby, Poppy. And there's Poppy right there about 2 months ago. So the book launch was on a Friday in September. And then literally 2 days later, we were in the hospital on the Sunday night. Well, I wasn't giving birth, but my wife, Stevie, was to our third baby, Poppy. It's very special.
So you had 2 babies in 1 week, the book and an actual baby as well.
That's right. Dear. And then Riz, or Rizal Ramzan when he's in trouble. So Riz is an associate partner, the GM and chartered accountant at Inspire. So Riz joined in 2016, which is 6 years now, or just over that. Which is pretty cool, working with Inspire after working as an in-house accountant for a few large companies around Brisbane. And you've saved a couple of mil in tax in the last year for your client base, and also given over $2 million $2 million days, not dollars, of impact to families in need as well through our B1G1, which is a giving initiative. All right. And you have some cute news too.
Yeah, I do. I'm kind of following in the footsteps, but about 2 kids behind. That's my beautiful wife on the screen. We got married only recently in January 2021. It was a pandemic wedding, so it was an interesting one. But we got through, survived, and still together. And with great news, great pleasure. We're also expecting a baby boy by the end of the year. And yeah, I'm really excited to share that stuff because all the stuff that we go through in these webinars and workshops is really, we're really family focused, and I do want to share part of my family in this story as well, because as we are growing as a family, we're learning more and more. There's some serious challenges when it comes to owning a business, and there's some serious challenges that might affect your family. So important to get the right advice at the right time to make sure that we can actually keep doing what we love with the loved ones that we have. So that's a little bit about why we do this stuff as well, and why I'm passionate and Ben's passionate about why we do these things. But yeah, enough about us. You guys have decided to take some time to a Thursday and spend an hour with some accountants today. We want to make sure you get a butt ton of value today. So we're going to cover a few things today in terms of like an agenda. The idea of today's webinar is to really show you what is this Division 7A loan and how to solve those issues. Now, as you can see, we're going to talk to you about some basic ways of taking money out of your business first, just to kind of lay the land a little bit, give it a bit of context, and then we'll explain what is Division 7A and why it exists. So it's a term that's always come up for business owners, especially if you have companies or bucket companies, Division 7A, this and that. We just want to make sure you get familiar on what it actually is and why it exists. Lastly, we'll also go through some short, medium, and long-term solutions. And the solutions is obviously broad-based, is across the board, and not exhaustive either. But we're using some of the common ones that we've seen in our time when we deal with Division 7A issues. Having said that, it is important to get bespoke advice around this stuff. So that's not a caveat or anything. I'm not saying that because I'm trying to protect myself. It's more so that certain strategies will have a bigger impact depending on your situation. It depends on your different income level, depending on your wealth position, and also some of your plans. What are your plans in the future? So it is really important not to take this advice and just go, yep, cool, You speak to your either your current accountant or speak to your friends and be like, oh, you can do this and that. It just depends on that situation. Is important. So if you're ever in doubt, give us a call. We can always chat about it. Obviously, if you're a existing client, we can obviously have a review and have a chat around your Division 7A loans as well.
Fantastic. Sorry, you caught me mid a side bowl.
That sounds good.
All righty. Well, we might start with taking the money out of a company versus a trust. And this is more so a refresher on, I guess, why this is sort of building into why Division 7A exists. But firstly, there's two sort of major structures in Australia for running a business. One of them is a company and the other one is a trust, which usually would involve a company as its trustee, or that would be highly recommended if we were structuring that business. So they're the kind of the two main options. Now, in terms of the company, the first way to take money out of the company is paying yourself a salary for the work that you do. So that's got to be sort of market rate. It can't be excessively high or excessively low. In terms of the salary side of things, and we can't do tax planning where we might pay a family member $100,000 to do an hour's bookkeeping a week. That Sid, thank you for your note there.
That was a test. Good job, Sid. You get a prize. It's actually 10.5%. I've actually updated that, Ben. If you just hit refresh somewhere.
I might be able to refresh that actually.
Okay. It is 10.5% for super, everybody. So make sure you add a 0.5 there. Thanks, Sid.
Thank you. And that's scheduled to keep going up over the next few years as well. So, and your payroll software should provide that, if it's set up properly, should provide the exact calculation of how much super needs to go. But even if you're paying yourself a salary as the director or a family member who works in the business, you need to take tax out of your salary, and you also need to pay super on top of that as well. And when we look at trusts, the salary is the same for a trust too. Now, you don't have to pay a salary from a trust. There might also be, there might alternatively be other solutions if you run a trust, like loans or distributions, which we'll get to, which are actually a bit more flexible when it comes to tax. But again, if you run your business through a trust, then you can pay a salary. But keep in mind the pay-as-you-go tax withholding and the super as well. Now, in terms of the next one, we've got another way to take money out of a company is to loan. So the company loans you or one of your other entities a loan. And now in brackets here, we've got Division 7A, because this is the whole purpose of the webinar, where we have these loans that get built over years, where people are sort of taking money out of a company, or we'll kind of run through a few ways, because sometimes clients say, well, I don't know where that came from. Where did the loan come from? Like I didn't apply for a loan from my own business. So why does it exist? We will kind of go through some common things of how they come about in a couple of the slides. But anyway, this is what we're here to talk about, because there is rules around taking loans from companies. Now, with a trust, you can also loan money from a trust, but we call it drawing. So there's not the rules like Division 7A attached when you're taking money out of a trust through a loan, which is kind of cool. Now, the third way to take money out, we've got dividends. So the company earns a profit, it pays tax on that profit, and then the after-tax income it can actually pay out as a dividend to its shareholders. So we need to keep in mind who are our shareholders, because it needs to be paid to them. We can't just sort of choose in the family group who gets it. It needs to be the shareholders. And that's a payment of prior year profits or previously earned profits. Now, with a trust, the third way to take money out is a distribution. In brackets there, we've got current year profits. So like, let's say the trust earns, $200,000 in the year. It has to distribute that every financial year. Otherwise, the trust will pay the top marginal tax rate of a fantastic 47%.
Ouch.
Not fantastic. And just to our regular heckler Steve's comment there, if you use MYOB or Xero or Reckon, they all should calculate that fantastic ever-changing super rate for you.
Oh, Steve, we love having you on the webinars.
It's been a while, actually.
It's been a while, it has. And yeah, the next bit here is kind of just explaining why Division 7A was brought in. And on the left-hand side there, you'll see a bit of an option or example of options on how you can be taxed on $1 million worth of profit. Now, it's obviously simplified, so we're not going to go through all the marginal tax rate, but option one, as you can see, if $1 million is made in your personal name or it's taxed in your own name, the top marginal tax rate, including Medicare levy, is at 47%. Now, it just means that after $1 million, you're going to be left over with about 530 grand after tax profit as well. So that's quite a bit of a hit. Nearly half of it disappears to the taxman. Now, the other option is to run investments or making a profit through a company. And obviously through a company, you're going to get taxed at, if you're a small business, it's going to be taxed at 25% flat tax rate. Now, the difference there is you're getting a flat tax rate, but they don't have the marginal tax rate system in the company. It's just flat from the first dollar. But after tax, you can see that you actually have about 750 grand in profit left over. Now, if we just look at that on a high level, we understand that after tax, in a company will have more cash in hand. Now, if we know the concepts of compounding, if we invest 750 grand versus investing 530K in something that returns, let's say 7-8% or maybe even more each year, you can see how it makes such a massive difference in terms of returns here. I'll get into that a little bit more later down the track. But the reason why Division 7A loans exist, or this rule came about, is this example on the right here. There's this person named Clyde Palmer. Sounds kind of familiar. And he wants to buy a boat. So he buys a $1 million boat. It's actually more than that, but it's $1 million boat that he bought. And what happened was Clyde decided to fund the purchase of the boat through using the company's funds. So in that option two, he just used that 750K after profit, let's say. Now, what happens there is he uses that to buy the boat, and then he doesn't intend to pay that money back, although the boat is a personal asset. Now, the ATO actually deemed that because it's a personal asset, it's not for the purpose of the company. It shouldn't belong in the company. The funds were used basically for personal purposes. So the ATO actually said, look, that should have been taxed in your personal name, Clyde, which means you should have paid 47% tax on that money instead of the company tax rate. So it's obviously nicer to buy a boat with 750K of after-tax profit than 530, because you can buy a bigger boat, right? But the problem is it wasn't used for the company. It was a personal use asset. So the ATO actually deemed that all that money that was borrowed to use with that boat, to buy that boat, was actually taxable in his personal name. And that's what we call a deemed dividend. So it's not really nice when the ATO decides to do that, obviously, because you're going to essentially pay quite a bit of tax on top of that. So about 470K in tax instead of 250. So the reason for this story just kind of explains quite simply, if you've paid company tax rates, the funds that the net after tax profit in there should be only used for the company's assets or investments or anything to do with the company itself. It can't be used for personal assets. Mm-hmm. So if we think about your situation personally as well, if you have Division 7As on your balance sheet, it is likely because some of that cash was taken out of the company and it was used in your personal name somewhere, or even in an investment somewhere else. It wasn't used within the company. So the ATO wants to make sure that if you use the money that belongs to a company, it needs to be paying company tax rate. If you're using that money to then buy assets in your personal name, you need to pay personal income tax rates on that. So that's the reason why it was brought in.
And in the illustration here, we give you as a boat, but I mean, even if you buy a personal use car in there, or yes, you buy your own home with company funds, so you need to pull out cash to pay the deposit and that sort of stuff. They're the kind of situations where we see these come about. And actually, we've got a slide here that goes through the common ways that you'll actually create a Division 7A loan for yourself. And actually, again, I said earlier that some clients actually don't know where the loans have come from, but often what's happened is that there's been more money taken out of the company compared with what the individuals have been taxed on. Mm-hmm. So if there's been more taken out than the individuals have been taxed on. So that's kind of the key thing to think about. Now, where do they go? It could be living expenses. I mean, if you sort of audit what you spend to keep your household running, add that up, and that's after tax, right? So let's say we spend our household spending, let's say 100 grand. We need to gross that up for tax and make sure that we're getting taxed on that between the people, the individuals living in that household. Mm-hmm. Same thing with like paying the mortgage, or a lot of business owners park excess funds on their home offset account to save on interest. In the meantime, in the meantime, while the cash isn't being used, so that's a big one. Property purchase. So you want to buy an investment property or your own home to live in. That's or other investments as well. I think we had a client who's like, why does this Division 7A loan exist? And then we pointed out, a couple of investment properties that they'd purchased and a share portfolio. We're like, well, there it is. Mm-hmm. These things need to, we need to make sure we treat them carefully or correctly for tax purposes as well. And then lifestyle expenses. So travel or toys, jet skis, boats, all that sort of stuff. If you're paying for those things with a company cash, then we'll be creating this Division 7A problem or loan.
And put quite simply, right? When we talk about that Division 7A, is basically the money that you take out from your company. There's only three ways, as we illustrated before. You either take a loan out, a salary, or a dividend. If you've taken more than your salary and it's just a transfer of cash, you don't process payroll, pay super on top of that, you just transfer the cash out, more likely than not, that's going to be a loan. Now, the question here is, where did that money go? Did that money go into living expenses, which you can't return back to the company? So because you spent it on a holiday or you spent it on a nice dinner out, that you can't return back. So our usual kind of a recommendation, I'm skipping ahead a little bit here, is to make sure that you match your lifestyle requirements, your living cost requirements, to your salary that's required. So whatever that you take out in salary needs to be, whatever you need in lifestyle expenses, you need to take that in salary, because you won't be able to pay that back to the company. Because if you did use that for personal expenses, it's just going to sit there as a loan outstanding. Now, there is a different part. We're going to talk about how we can structure it for investment purposes, or property purchase and things like that. Cool. So the rules are quite simply. Now, let's say you've done that. You've taken the money out. There's a loan on your balance sheet sitting there. It's owing back to the company. Here's how the ATO applies those rules. So first of all, it was introduced in 1997. So it applies to only loans after that period, which is most likely any loans that you have now. And then what you need to do also is you need to document the loan. So it can't be like a revolving facility or credit. It needs to be documented for that year. So if you took out 100 grand for that year, you need to document what the principal amount was taken out, and what we need to do as well is calculate the interest and what the maximum term is. So in other words, what we're turning into this loan into is like almost like a commercial, an arm's length loan that you would have taken out from a bank or a lender. So you're documenting principal, interest, and the maximum term, which also will give you the repayments required each month or each year. So that needs to happen. And the ATO gives you the rate. So they actually have a resource on their website where you can check what the rates are. It does change, right? Obviously, with the rates increasing right now, that changes it as well. The ATO has advised that the rate is currently at 4.77%. Now, for those of you who are thinking ahead right now, you might be thinking, oh, is it better to borrow from my company to invest or borrow from a bank? You're going the right path here in terms of using a loan from a company. There's a way that we can use that. So 4.77%. Now, the next thing is you can either take an unsecured loan or a secured loan. The difference there, obviously, this is, again, to reflect what we would see in commercial terms or arm's length terms. If it's unsecured, it's more risky for the company or the banks. Obviously, they want to be paid a little bit quicker, right? So 7 years is what's the required term if it's unsecured, which most Division 7As that we've seen is unsecured. You've just taken the money out. There's no recourse. There's no collateral. If you've taken the money out and you want a longer term to pay it back instead of 7 years, let's imagine, you took out 700 grand, just trying to make it easy here, it will be 100 grand a year plus interest that you have to pay back, right? If it's 7 years. Now, that's a lot of cash that you have to put back into the company. If you wanted to extend that a little bit further, you could secure that loan and have 25 years. So you can see that that's not too dissimilar with a home loan or a mortgage. That's where obviously a home loan's a little bit less risky for a bank, right? Because you have actual property as collateral sitting there. So in the secured loan, there's a process to go through, of course. We won't go through too much in detail, but you essentially can secure a loan that you borrow from your company on, let's say, something like a property. The last one also is worth mentioning is we've been talking about taking money out from a company as an individual, like Clyde's situation. But it works in the other way as well. If a trust makes a profit each year and then it distributes to what we call a bucket company, if it doesn't pay that in cash, effectively what it's done is it's borrowed that money back. It's a bit confusing, but essentially it's you're withholding the cash that is legally entitled to that company now. So because you're holding that cash somewhere else, either in the trust or it's sitting somewhere else personally, you've essentially borrowed that money. Now that will be also considered a Division 7A loan. So you might have a mix of different types of loans on your balance sheet. If you have a bucket company, it's likely that last one. If you don't have one, it's likely the one that you have from the company to yourself.
All righty. Well, let's get into some of the solutions that we have available to us. And the first one I'd like to run through is actually your. So when you, I mentioned it earlier, where we've seen people sort of put money from their business into their offset account throughout the year and then swing it back in, like on the 29th of June, they repay the whole amount. And then on the 2nd of July, they take it off again. Now, that really isn't a solution at all, because technically that doesn't count as a genuine repayment if you just rip it back out in early July. So this needs I guess what we need is an effective solution for the medium to long term. But the ATO haven't had a really good crack at this. It's absolutely on their sites though. And yeah, if we read the rules as they're written, this dance around 30 June really isn't something that we can rely on to say, hey, that's our genuine repayment. So let's look at something else.
Yeah, moving past that, if we look at medium-term solutions, without kind of going through the slides yet, it's just making sure you pay it down. That's the medium-term solution. We need to. So the trick here, if you look at your balance sheet, you want to make sure that your loans, your overall loans, are reducing. So how do we do that? How do we reduce it? If we think about it logically, to reduce a loan that we owe to a company, you have to pay it back in cash. That's usually the logical first step, right? So you can make repayments back in cash, or alternatively, what we do is we pay dividends out from the company. Okay, so if we pay the dividends out of the company, essentially what's happening is we're getting tax on that money that we've taken out. So that's the first part that we need to understand first. But we're not getting the cash because we've taken that cash in advance. We're just taxing that bit into our name. So that's what a dividend does. So we're just on paper writing down a dividend, and then you get tax on that. Now, the trick here to manage that taxing point, we don't want to tax, in my example just now, if we took out a 700K loan, we don't want to make sure you get taxed in 700K in 1 year, because that will shoot you straight up into the top marginal tax rate of 47%. Instead, what we aim for is we make sure that the loan is on commercial terms first. If it's 7 years unsecured, it has minimum repayments to be met in those 7 years. Now, the way that we make those minimum repayments each year is to issue a dividend to the exact amount of that minimum repayment, obviously inclusive of interest as well. That's what you get taxed on each year. That way, you still get taxed on it, but you're stretching it over 7 years. You know, in my example, 700K plus interest, 100K plus interest per year. That's what it will look like. So it's a bit more palatable, because at 100K, if imagine you don't have any other income, you're actually in that middle tax bracket of 34.5% rather than 47%. So that's a great strategy. So again, to see whether this is being applied, is your loans reducing each year? If it's not reducing, there's something going on in that medium term. If it's increasing over time, you need to speak to someone about that. Now, the next dot point there, I should mention. Yeah.
Well, I think, I don't know whether you touched on the salary itself.
Sorry. Thank you, Ben.
Oh,
The other way that you can also reduce the unsecured loan is, again, remember there's three ways to take money out of the company. One is dividends. The other one is obviously just to issue a salary to you. Now, with the salary, the difference between the dividend and the salary is, as Ben mentioned before, with salary, you have to pay super on top of it. And you also have to prepay some tax on it as well. And there's some other things like work cover that gets impacted, things like payroll taxes, things like that you take into account as well. However, salary is a good way to do it because it's actually the first method. Because if we think about it, if I already take out a 50 grand salary, I need 100 grand to live on gross. I only have 50. I borrowed another 50. Technically, I should just have 100 grand salary just to start off with so that I don't have a loan. So that should be the first step already before any further loans that are taken out. So you need to make sure that your salary is commensurate of what's required for you to live on as well. But you still can do that after the fact. Let's say at 30th of June, you can issue a final quarter bonus or anything like that, but you've taken the cash out as well, where you pay super and all that stuff on top as well. So there's different ways where you can reduce it, but overall you can see how we manage this to make sure that it's the right way to do it. Because remember, the other difference here from dividends and salary is that dividends only flow through to shareholders. It doesn't just go to anyone. You have to be a shareholder of that company for you to receive that dividend. Now, if you've worked with us before or you're a current client, more often than not, it's a family trust or discretionary trust that holds the shares in your company. So it means that we can distribute some of that dividend across. Now, that's something that we just have to be careful of, obviously, because the dividends is fixed to the shareholder. So that's dependent on where it goes. The other point that I've just put an asterisk there is, if you want to issue a dividend, if you want to choose that strategy to pay down your loan, you just got to check your franking credits. Now, I'm going to say quite high level here because it can get quite complex, but franking credits essentially is tax in which the company has already paid on those profits. Tax which the company has already paid for those prior year profits. Now, when you issue a dividend, the company has paid 25% tax on that money. So when it arrives in your name, to avoid double taxation, you don't get taxed the full 34.5% marginal tax rate because it was taxed previously. You actually get a credit for that 25%. So actually, there'll be a slide after this will show about that franking credits. But essentially, we need to just check that you have enough franking credits to do that. So that's an important bit. That's all I'm going to go for there. It gets pretty deep after that point. Now, the next point there, it says cascading loans. Now, that's what I've mentioned before is you just want to make sure that each year has its own loan. So if you took out 100 grand in year 1, year 2, you took out another 50 grand, year 3, you need to see 100 grand, 50 grand, and 50 grand separate. The reason for that is each one of them has their own minimum repayments, their commercial interest, their benchmark interest rate, and also their own whether or not it's secured or unsecured. And because it's the oldest one, you have 7 years to pay. We obviously pay the oldest one out first before the newest one as well. Now, one of the other strategies that we can do as well here is to build up a loan. This is intentionally using the loan as a strategy. The reason for that is what you might want to do is rip quite a bit of money out, or you want to pay some dividends, either at a minimum repayment rate or a full loan if you need it for some big investment, like usually property is the big one because you need a big deposit to rip out of the company. If you know that you're going to do that, but the timing is, I want to issue the dividend next year. What I can do is borrow the money in this financial year, invest that money, and then next year issue the dividends to clear that out, knowing that you can pay those dividends out as well. Again, checking for those franking credits. So what I'm trying to say there is, it's not an issue if you did want to rip out quite a bit of money for investment purposes. It's just that we've got to issue that as a dividend within the next financial year, or again, enter into complying Division 7A loan with those minimum repayments as well. Okay. The bit that we're saying here about when it's useful coming up to retirement or a business exit. If you know your business is you're gonna finish up, you're gonna sell the business off, what we usually recommend is to make sure you get as much of the franking credits that are attached in that company out of the business. So one way to do that is to issue frank dividends, and it will follow the franking credits are valuable because it's tax you've already paid to the ATO that you get a credit for, right? So you want to issue those dividends, tax paid money out into a bucket company, for instance, to hold the cash there. Now, if you dividend all of that money out, that's a good way knowing that you're emptying out the company, you've taken all the cash out before you sell this business to someone else. So they don't get the benefit of those franking credits as well. So there's things like that can help you with those massive Division 7A loans during those exit periods.
Cool. All righty. Well, we've got our long-term and permanent solutions we'll run through now. Well, the first one's the kind of the obvious one is that you actually repay the cash into the company. But our comment here is that might actually be a poor use of funds from a couple of reasons. Like, do you just want cash sitting in a company not doing a lot? That's kind of one question. But if you're putting cash back into a trading entity, then you're actually putting it at risk as well. So that's like an asset protection concern of ours, is where you're actually sort of paying this cash and letting it sit there long term. I'd kind of question how that is from an asset protection perspective. So yeah, while it is a solution, it's probably not one we would love or we'd guide a client to do as a long-term or permanent one because of those other risks. Another one is paying the top-up tax. So this is where, let's say you've got $100,000 in a loan that you owe back to the company. You actually just pay that $100,000 as we talked about before, a salary or a dividend in one hit, and we're going to pay top-up tax on that. So if the company tax rate's 25%, you personally are 47%, then you'll be paying $22,000 as a top-up tax on that $100K. So yeah, I mean, that's another thing that you could do for a permanent solution where you no longer have that loan anymore. Again, we'll do it in one hit. It'll just depend. Some clients completely hate Division 7A loans. I don't want them, and they just want to pay the tax to get rid of it. There we go. Versus like paying it off with dividends or salary over years, like the medium-term solution we spoke about before, Riz mentioned. That may be actually what we do more so recommend from a cash flow perspective. Jumping down to this one here, buying shares or managed funds in a bucket company. So this is where we actually, so like the first one, we actually put the cash into the company or leave it there. We don't loan it, and then we actually put it to use. So buy shares or managed funds. And I've got the note here, not a trading entity because of the asset protection risk. And also ideally income-focused investments versus capital growth investments. Now, I say that because in a company structure, you don't actually get the 50% capital gains tax discount for selling an asset like you do in a trust or a personal name. So again, if we're investing in income focus, we're not going to have that capital growth side as much if that's our focus is income. So that when we forego that capital gains tax discount in the company, it's not going to be as bad, so to speak. And you can find managed funds or that sort of thing that are more income focused than capital. The last one here on this page is a secured loan. So basically that 25-year repayment term, which means smaller repayments each year. And that means smaller amounts that you need to pay this top-up tax on per year because the repayment's smaller. So you can use that secured loan as a deposit for an investment property or even on your own home, like to buy your own home. Again, you could borrow your initial deposit from your own entity and then the balance from the bank. We've seen that done before, but that's kind of the thought process, is that a secured loan gives you longer to pay, smaller repayments, and a little bit more long-term approach.
Yeah, and I should mention just quickly there, Ben, there's a tinge of asset protection consideration that we need to look into when we come up with some of this strategy. So we were just outlaying what are the strategies. When we do this, we usually do it holistically, looking at what risk factors are there as well when it comes to where you invest, in like what Ben's mentioned there, where you invest your shares in or manage funds in. We just want to make sure they're not sitting in entities that because the analogy here is like, if you think about like a poker table, right? So if you're betting all the chips, and you're making profit, you're winning profit. If it's all sitting on the table, i.e. in the trading entity, it's still at risk. People can call on that money. Now, what you want to do is cash out, but still not pay too much tax. Now, that's a asset protection webinar, but that cashing out bit is important to understand. When that cash comes out, we want to maintain the same tax rate, but invest it somewhere else. So the trick here is, when we apply any of these long-term or permanent solutions here, asset protection is a key bit to understand as well.
All righty, let's run into more long-term or permanent solutions.
Cool. Yeah, and there's a few more kind of, it starts getting, you can see it's simpler and starts getting a bit more complex. But where we've seen there's an opportunity to get rid of quite a bit of loan is actually in the event of a restructure. Now, I wouldn't just restructure just for Division 7A purposes, for tax purposes only. Usually a restructure happens when you've outgrown your existing business structure. Now, what usually happens here is when you move from a trust to a company. So a trust is a good entity to start with. It's a family business, you've got discretion, but then your business grows up and it starts becoming, more corporatized. I can imagine everyone wearing suits when I say that, but it becomes a corporate entity where you can streamline the management of the balance sheet a bit better. So if you want to do that, what you can do is you can introduce a new company or a holding company. And essentially what it does, it buys your business or shares, depending on your structure, of course. Now, when that holding entity buys a business or shares, you can essentially win on a few things. One, when you buy that entity, you got to buy it at market rate. So what happens is you actually buy at a certain cost base. Now, what's good about that is if you sold it externally at under track, that's your new cost base. For those of you who are either accountants or super sharp with this, the first question usually is asked is, well, if you buy it internally, won't we pay tax on that? Correct. If you do it properly and you know your CGT concessions, when there's a business structure or business sale happening, you might be able to get away with little to no tax as well. So again, not going to go too much on the CGT concession side of things, but there's ways where we can manage the tax in the event of a restructure. And obviously stamp duty is something we have to keep in mind as well. So when that happens, we buy something, we need to either, purchase it in cash, or we buy it on credit or a loan term. So when that happens, you're buying it on a loan term. What it creates is a reverse Division 7A. So let me just pull the picture out of a trust and a company again. If a trust sells the business to a company, the company then owes the trust money. So the basic rule of Division 7A is, if it's only a Division 7A if you owe the company money, because the company is the one that pays the flat tax rate. But if it's the reverse, the company owes you money or owes the trust money, then you have this reverse Division 7A, I want to call it. So essentially what can happen is, now every time the business, which is now held in the company, makes a profit, it needs to pay back that original loan or the vendor finance back to the trust for the purchase of that business. Now, because it was purchased on a capital gains concession basis, you've already paid the tax, or you've looked after the tax impact on that. The cash that flows back essentially is then tax-free, or little to no tax on that. So that example at the bottom gives a really good understanding of how that works. I'll just read it out. A new company buys your business for $2 million from the current trust. The company has $10 in it beforehand, so has to loan the money through vendor finance. Therefore, it immediately owes the trust $2 million. And you can take up to $2 million out of the company after only paying 25% tax on it. So it's not tax-free in the sense that there's no tax. Remember that the company still makes profit and has to pay the flat tax rate of 25%. It's the top-up tax that you don't have to pay after that, because the money is then owing back to the trust. Now, this is a fairly complicated concept. We've tried to distill it into 4 points, and there's actually quite a big process to do this. But where I would go with this is, you can actually create a forward Division 7A loan. That's all you need to take away from here. So that's by restructuring your business. And again, you wouldn't do this just for tax purposes. It's also because your business is probably outgrowing that family trust structure before that we talked about.
All righty. Well, that is all of the solutions that we've got to sort of run through on the call today. I've been having a bit of a side chat with one of our clients, and we've identified that there is an additional one, but it's fairly advanced, and we won't actually put that on the webinar today. But if you do want to talk with us more, we've got two ways depending on where you're at. So if you're a current client, then please book a Zoom or a meeting with your Inspire accountant. We can have a chat and review your Division 7A stuff if you want to just check in on maybe what option we've applied to you or we're using with you, just so you make sure you understand that. And if you're not working with us at the moment, keen to explore, then feel free to book in for a strategy call or an initial call with one of our accounting team. And the link, thank you, Ronalyn, is in the chat box if anyone is keen to do that. And again, it's Division 7A isn't a super crazy thing for us to handle. And as we've sort of talked through in the webinar today, there are varying levels of solutions that we put in place, and it very much depends on the client. So do keep that in mind. Also, we will post the recording of this video on YouTube. We will put the full thing on that, but feel free to follow us on Facebook, Instagram, or all the other things too, if you want to keep in touch and see what we're getting up to. Oh, yep, there's a bit of a nudge on the strategy call if you do need to chat with us. But that kind of brings us to the end of the webinar today. If anyone's got any questions, please pop them in the chat box now. If we, so we're around for a few more minutes if you're keen. Otherwise, make sure you book in for our next webinar, which is getting a business ready for sale, all the ins and outs and things to consider on that. Thanks again, everyone, for joining.
Thank you, Ben. And yeah, we've got a bit of time. If you do have any questions, please pop it in. There is the Q&A box or the chat that you can use right now. In terms of like some stuff that we didn't get to cover because we got just a bit of extra time. We talked about bucket company fairly heavily just then about using bucket companies. Now, if you're new to this concept of a bucket company, in my analogy of that poker table, when you cash out, there's a place that you can put some of your profits to make sure it's protected. Now, I'm going into asset protection and a bit of a different webinar here, but that can help you to save quite a bit of tax by putting it into another company. Now, there's a way, obviously, to get that money across in a tax-effective manner. But once you shift that profit off the table into a bucket company, that's kind of your safe haven for any excess profits that you don't need for lifestyle, don't need for holidays or home renovations or a new house, anything personal. It's the bucket company is a great investment tool if you want to invest in property, shares, or even crypto, whatever that tickles your fancy and based on your risk appetite, you can put it in the bucket company. The reason why it's so cool, I get excited about this stuff, and you might be wondering why you're so excited about a company. The reason why it's so cool is it pays a flat tax rate. Because it's not a trading entity, it pays 30%, boo, but still good, better than 34.5 or 47% in your personal name. It's that power of compounding again. So if you invest, I'm talking about the same investment here in your personal name versus a bucket company, just by the tax environment difference, the tax rate difference, one outperforms the other because your net after tax return actually beats the other one if it's the same investment. The compounding effect in that, we used to have a little slide that we would show, but a compounding effect in that is insane. Within 10 years, you're like, why am I doing this in my personal name ever? Why would you ever do it there? So there's things like that we also help our clients with to just identify some opportunities and introducing concepts like bucket companies in their structure. Now, it might not be for everyone. It depends on where you are in your journey. But if you're at that point of thinking, man, I'm making good profit, especially after the last 2 years, I've got profit coming my way, I don't know what to do with it or how to best invest this, definitely get in touch. Because the compounding effect, when we talk about compounding, the best time is yesterday, because the longer that you have done this, the more it returns to you. And it's the gift that keeps on giving. So if you ever want to have a chat about that stuff too, get in touch, particularly with me, because I get excited, too excited with this stuff sometimes.
Hey.
But yeah, if you have any questions, even around that stuff, feel free to chuck in the chat box. But if not, we might give it a couple minutes and see if anyone's interested to chat, and we might sign off after that.
Cool. We did have one question, which was if I've got a company that lends money to another company, is that Division 7A? But the good news is that is not. So company-to-company loans are excluded. There's a specific exclusion on that, but it's company to trusts or individuals that we need to have a look at.
That's it.
Yeah. All right. But I think that might be all the questions we've got.
I think so. Cool. Well, just want to say thank you to everyone who joined us today. And a special shout out and thank you to all our existing clients as well. It's good to see you guys not sick of us yet, seeing us at the same face on the webinar, on the call. But yeah, thank you again for taking the time today. If there's anything that we can help with, please do get in touch. We have the link to that strategy call. Ron, if you can post that, that would be great as well. Thanks, everyone.